Welcome back to my Hargreaves Lansdown investing portfolio for October. We are nearly at the end of the year. It's unbelievable. Last month, we were at a total of £41,574 in my account. Now, I can already tell you this is not going to be a very pretty update at all. We're definitely going to be quite knee-deep in the red, and we can all have a nice pity party in the comment section together. Just as a reminder, with investing, we're all in this one together. Now, as you might expect, my portfolio is very much the same as the rest of the market. The S&P 500 right now, as I record this video, is down over 8%. And the NASDAQ, which my portfolio is probably more comparable to, is down more than 10% already in terms of just in 1 month movement. So some pretty crazy things going on right now in the stock market. Investors are having a terrible time. And just before we jump into the portfolio, one observation I wanted to make, which has been quite interesting so far in 2022, is that almost no matter what you've invested in has gone down in value. And that does include the bond market, which is meant to kind of be that part of the portfolio, which gives you a fixed income and actually gives you some decent positive returns. However, have a look at this article here on screen from Forbes. It's saying that 2022 has been the worst year for bonds in 45 years. And out of all of those years, bonds have only fallen in prices 5 different times, the worst being 2.9% in 1994. And apparently 2022 is probably easily going to be one of the worst on record ever, as we're currently down around 11%. And that's quite an extraordinary thing to see, that both bonds and stocks are all down at the same time. And that's pretty much across the board, no matter what the sector. I think the only thing holding up at the moment is energy. But of course, unless you've overweighted your portfolio massive to the energy sector, then unfortunately, we're all in this one together. So let's jump into the portfolio now. As you can see, we're actually finally in the red overall. I think this is the first time I've seen this account like this for a very, very long time indeed. You'll notice a couple of things which have really caused this is certainly from the tech sector and certainly from the chip manufacturers. So 2 of my big investments here from the likes of AMD and Nvidia. But of course, Tesla's also fallen massively too. I think Tesla was up about 120% at one point. Tesla, of course, has faced a few different headwinds going on at the moment. Of course, we've had the overhang from all of the Twitter acquisition. We'll see if that one actually goes ahead and whether Elon has to sell any more shares. Of course, there's lots of macroeconomic things going on at the moment with high inflation, interest rates being risen. But of course, everyone's concerned about the Fed, demand from overseas, the strength of the dollar, certainly against those overseas currencies. Loads going on, of course, China factory shutdowns, and then of course delivery numbers, which were forecast for Tesla, were also a little bit disappointing from what analysts were expecting. And there's now a slight gap between those cars that have been delivered and the cars that have been produced by the different factories. And now it's going to be very interesting when we actually see the full Q3 results and seeing if there is a bit of a slowdown and a compression in those multiples that Tesla has been akin to. I have always said that Tesla has been very much priced for perfection. So unless they can deliver those 40-50% increases year on year, we are going to probably see it being beaten down. How far it can go, who knows? There's certainly a huge community there of strong retail investments which claim to have diamond hands, but as always, everyone claims to have diamond hands until they don't. So it'll be very interesting to see how this one goes. Now, aside from Tesla, in the rest of the tech world, AMD and Nvidia, big holdings of mine. Now, AMD have had an absolutely terrible ride this year. They've been on quite the roller coaster if you have a look over the last 5 years. In fact, if you have a look over this sector, the kind of semiconductor sector, I'll put this up on screen now on a Google chart for you over the last 5 years. I'll put the likes of AMD, Nvidia, Intel, and TSMC. You'll see that they've all relatively come to the same position. Some, of course, have had a wilder ride than others, but they've all been hit, certainly recently, if I then change that 5-year chart to a year-to-date chart. So you can see, of course, that the forecast of demands and the sentiment in the market is that the pulled forward demand that we had post-pandemic and during the pandemic when everyone wanted laptops and graphics cards for mining, etc., huge different catalysts have come together for demand, and now those things have slightly been pushed out a lot further. Now, let me just show you what this means in real terms. Of course, AMD actually came out with a pre-announcement on their Q3 results saying, look, guys, things are going to be a little bit worse than we're probably going to expect. So we'll tell you some of the results first now. So if I throw these ones up on screen now, you can actually see where the damage is coming. Now, the expectation for Q3 for AMD was $6.7 billion, and they're saying it's probably going to be a lot closer to $5.6 billion, which is a huge miss. When you talk about missing expectations in terms of analyst stuff, you know, normally you'd be out just a couple of 100 million or something. That might be a big dent. Now, that is a significant gap. Now, the big cause and the big factor doing that, we actually see what segments that AMD sell, and really that's come down to the client perspective. So client, of course, is going to be anything in actual desktop PCs and laptops, etc., which of course you can't get a 50% demand and a 50% increase year on year with those. That would seem pretty logical and rational to me. I don't know about you, but of course that demand was pulled forward throughout the pandemic. So clearly analysts and investors weren't very impressed with that, of course, because they just took the last year's numbers and just said, let's do 50% on top of that year on year. Of course, that makes perfect sense, right? Now, aside from that, from my own perspective, what does impress me is where the numbers we're looking at in areas like data center and, of course, gaming. Now, data centers as a great part of their business. If you think about that, 45% year-on-year increase with a $1.6 billion revenue is extremely impressive. That tells me that lots of their big customers are still spending lots of money. But then also gaming doing pretty well, up 14%, if you consider a lot of the graphics cards were being used to mine Ethereum. And Ethereum's now moved to a proof of stake model. So graphics cards have finally now got back into the stock, into the inventory for the distribution team. And it's going to be very interesting to see how this market still grows. Of course, as a bit of a nerd and a gamer myself, the likes of Nvidia and AMD are always competing who can provide the best graphics cards for gamers, because of course they just go into consoles as well. But it'll be interesting to see where the demand goes in a high inflationary environment with no one having much money to spend, cost of living crisis. Do people still prioritize buying those in the short term? Possibly not, but long term, the real money, of course, is going to be in that data center segment for them. I won't spend too much time on Nvidia because they've really had a similar journey, and the likes of Intel too. I don't have Intel in my portfolio, but as I did mention earlier, all of that sector has had a bit of a massive downturn, of course, as the expectations for growth and the sentiment, of course, is pretty poor. No one's going to spend money on those high-end devices, high-end things, which are not essential, and they're ultimately a consumer discretionary item. Now, all that means to me as an investor is this short-term sentiment's really bad. And actually, if you look now and you can see the prices in my portfolio are less than what I paid for them, personally, I think that's a fantastic opportunity to average in. If you think there's a price which is right for you and you've done your analysis on the stock, well, what's not to like about the current pricing? If you do have cash to deploy, personally, it's a great time to get in, especially for the long term. Always caveat on long term. In the short term, absolutely anything can happen. And we're seeing it live right now every single month. And no doubt as well, you're seeing that in your portfolio. Even if you're invested in what we'd call, safe index funds, doesn't mean they can't go down. Just means, of course, they tend to be less volatile. But so as a reminder, if you haven't yet invested at the moment, then just be prepared for it. And I guess I kind of keep myself calm knowing that this was an expectation from the beginning. But if you go into this thinking they're only going to go up and stocks increase every year by 10%, then you'll be very, very disappointed indeed. So prepare for the worst, have everything ready at the beginning, and then you should be able to get through this over that long term. Now, speaking of more long-term investments, one of the newer acquisitions in my portfolio was Google. I do have Google in other accounts as well, but I did sell BP just a couple of months ago now to get more Google stock, and they've still been going down. Now, personally for me, Google is an absolute steal at these prices. And if you did put a gun to my head and said, okay, you had to pick one, and you had to be an uber bull for one stock, that's all you're allowed to invest in, I would probably pick Google, to be honest. I think their moat is fantastic from a financial health perspective, an extremely strong balance sheet. They're buying back shares. They have other parts of the business other than search, of course, with the data center cloud business, which is still losing money at the moment, bear in mind. If they can scale that to a position where they start winning money and actually making some income from it, it's a phenomenal business, in my opinion. But of course, you should never go YOLOing into all in one stock. That's foolish, in my opinion. But if you did force me, this is probably one I would choose. So all I would say personally for me, for these prices, the company doesn't actually have to grow a huge amount per year compounded over the next 5 to 10 years to give back some incredible returns. Now, while I've just reminded myself about this, one caveat for all of this potential US stocks on sale is remember that our pound at the moment is in quite a depressed value against the pound. So do bear that in mind, that although if a stock might be 50% down for the year, if our currency is then down 20% for the year or 15% for the year, it just means it's not quite as attractive. So just consider what you're doing at the moment. I still do think there's some good bargains here, but it might be then a strategy to say, okay, I want to average into these stocks and wait and see what happens with currency. Again, then you're kind of getting into the elements of time in the market. So it's a very, very tough one, but you do need to think about it and be aware of it. You would like to think that the pound can only go up from here. But again, that's another thing that I would then say, just because it seems rational and logical doesn't mean that that's what's going to happen in the market. Of course, we go back to the famous saying that the market can stay irrational for longer than you can stay solvent. So just be careful, just be mindful. It comes back again to your own personal risk profile and your own personal tolerance of what you want to do. Now, if you do want to come into the game of buying individual stocks, then you do need to take the mental fortitude and the pain and suffering that potentially goes along with that regardless of some of the best stock pickers in the world, always Peter Lynch's one that comes to mind, during every single market crash and correction, his record was, as in his own words, would be he would lose every single time. His portfolio would go into the red, his stocks would go down. But as long as you have confidence in what you've bought and they are strong companies that can weather through times of high inflation, deflation, potentially high interest rates, low interest rates, etc., good times and bad times, then you'll put yourself in a much better position. Briefly going over the other holdings, you can see Apple there remaining pretty strong. It seems like one of the only safe havens for money at the moment. However, lots of people always say, look, if the stock market is going to bottom out, Apple will be the one to fall even further. And I think we are going to maybe then see over the next couple of quarters, I'll be very interested to see how Apple perform with the new iPhone 14 launch. It seems as though looking at analysis so far that it's done pretty well. And actually people have tended to go toward the Pro models, aka the more expensive and the models that are actually going to give them more profit. So be very interesting there, and maybe weaker demand for the actual base model iPhone 14s. Be very, very interested, especially as we go into the next quarter and of course Christmas time, typically a huge one for Apple. So I think we'll be all very interested to see how that one plays out, because I think that really is like a bellwether of the economy. If people are going to spend quite a lot of money on Apple products and really whether they're going to choose to upgrade this year, even if they're a couple of years out of date. I mean, I'm in a similar boat, to be honest. I've got an iPhone 12. I potentially would like to upgrade to the iPhone 14, but of course, if I didn't have to, there's nothing really that I would personally want to upgrade to. So we'll have to see how they go on, and we'll see some new iPads probably and some new Macs potentially. So again, let's see how Apple do. But if Apple falls, you can expect everyone else to absolutely fall even more. Just finally touch on the rest of our American stocks here before we go to the last couple of UK picks here. So PayPal was another stock that I picked up just a couple of months ago, doing relatively well for me. At least this one's in the positive. Now, I think PayPal has a great moat in its brand. And although I think it's a very competitive space because online payments, effectively anyone could, in theory, start one up, it's having that brand and having that trust with people and consumers that really gives it its power. So let's say if you were checking out on a new website that you haven't ordered from before. Now, I know from statistics that the majority of people would choose PayPal over someone else because, of course, PayPal are protecting your data and your credit card information from that merchant. Now, from the merchant side, of course, there is a bit more of a pushback because lots of people say they hate working with PayPal, and they were in some controversy recently with some terms and conditions that they pushed out and potential issues with them saying they were censoring different people for spreading misinformation. They rolled back on this. There was quite a lot of backlash on social media. Lots of people saying they're deleting their accounts. But in all honesty, from my perspective as an investor, I think that's all a bit of just short-term noise. So I'm not really bothered about that. I think they've got a huge market to go after. That market is growing with online e-commerce, and trust, I think, is one of the most important things. And so far, they've got that. So they can hold on to that and hold on to the brand. I think they'll do very well. Now, quickly touching on our UK positions, Unilever, as you'll all know if you have Unilever in your portfolio, just does nothing. So it's a bit of a regret for mine. It does pay out a dividend, to be fair. So if it does stay flat and pays your dividend, it is technically giving you a return. But we'll be very interested to see some actual change there. Now, I'll correct myself if I'm wrong, but Alan Jope, the CEO, is stepping down or has stepped down. I forget exactly which date. So new leadership potentially will change the direction of the company. Be very interested to see how that one goes on, because really otherwise I quite regret having Unilever here. It feels a bit too safe and boring for me. I'd rather have something a little bit more riskier, a little bit more with room to grow. However, in theory, a company like Unilever, with all the brands it has, should do very well in a high inflation environment with that kind of consumer goods that it offers. Now, I'll touch on a kind of fan favorite here, Legal & General, big UK stocks. I did just receive a dividend from these. I actually withdrew it from my Hargreaves Lansdown account. I sent it over to my bank, and then I sent that straight through to my free trade account. So in case you don't know, I do run a small UK dividend portfolio that I'm building out. So I took that money, so I thought, I did actually want to reinvest into Legal & General, but I also wanted to take the money and get a few other positions as well. And I thought, right, rather than pay Hargreaves Lansdown to do that, because £11.95 per trade is a little bit expensive. I know you can do the reinvestment for £1.50, but still I thought I'd just take that money out for no fee and then go and invest it elsewhere. Now, interesting enough, they've had a very, very tough year so far. They're down 25% if you have a look on the charts here. Bear in mind, they have paid out dividends, so you always need to bear that in mind when you're looking at a stock chart. Now, recently, it's been super volatile in the UK with the Legal & General share price, and any other company who was potentially exposed to all of the goings on from the mini budget and the fallout from the mini budget. Legal & General do manage lots of pensions. However, they did come out and say that they weren't forced sellers of any of those long-dated government gilts, but no doubt the stock price said otherwise, and people clearly were worried and were pulling out. And I think even if we have a look today, as I film this, the share price is rallying up 5% on a day, which is just crazy amounts of volatility for a well-established player like Legal & General. So again, long-term play, I think the company's safe. If anything, fantastic time to potentially pick up some shares in that company. They were one of my best picks, I think. And for a lot of you in your portfolios, I know you're big fans of Legal & General here in the UK. Again, in that great market of insurance and investing and wealth management, which throughout thick and thin should do pretty well no matter what we go through. And they've always been a solid dividend payer too. So again, you can either take that money for income if you're relying on that, or a fantastic way to reinvest. Now, rather than boring you with all of the individual stocks and trying to go through in too much detail, I always like to try and kind of give a lesson each month and try and figure out what's been going on. And if anything over the last month, I think what I've learned, and I think what I've reminded myself, of course, is how important diversification is. As you've seen, the movements in different stock prices can absolutely be incredible in any given year. And if you're dedicated to one sector, for example, whether that's tech or whether that's quite speculative companies who weren't giving profits, then of course you'll be down massively for the year. And of course, as a human, you have to appreciate that you can't know everything. So you have to use diversification to protect yourself in any given year, in any given circumstance. So really, this is a great reminder to do that and make sure you're in multiple sectors. And of course, the way I do that is by making sure that index funds remain the core of my portfolio. So if you do follow any of my other portfolios and follow the rest of my investments, you'll know that that is the core of my portfolio. And this is a side portfolio, as well as a couple of other side portfolios that is kind of more of my actively managed money. But I definitely do not pretend I'm going to be some kind of Warren Buffett. And I have fairly low expectations for that and remain kind of skeptical of my own ability, certainly. And then, of course, I think it's a great reminder that, look, anything can happen in the stock market. Even if you take relatively safe and large companies, I think the likes of Apple and Microsoft, for example, if you just look at the 52-week price difference in what the lowest was and the highest was, I mean, you're talking about a 50% price difference in any given company in any given year. So that is a huge range. Now, has a company changed 50%? Do you think Apple or Microsoft have changed 50% in 1 year and have justified that with their financials? I think the answer would be absolutely not. It just shows what the weighing machine, as people like to say, of the stock market is in the short term, that anything could happen. As sentiment changes, as mood changes, as different economic factors hit the stock market. As I said in my last video, everyone's playing a different game here. So make sure you stick to your plan and then figure out what makes prices and what makes things sensible for you to take that into the long term. Because I'm always talking from a long-term perspective. You might not be a long-term investor. That's absolutely fine. You might want some short-term gains. Absolutely fine. Play your game there. But just be aware of it and be skeptical. And of course, always, there's no rush. And finally, let me leave this point with you. You might think I should be crying right now with the portfolio in the red. Why is this guy not very sad? Why is he putting on a brave face? And I think the reason I am like I am now is because the more I understand about the market and the longer my timescales, the more I appreciate that anything can happen in the short term in the stock market. I actually don't mind where things are at the moment. And I also don't mind how things are at the moment because I'm not under any pressure to sell my stocks to pay for anything else. And of course, this just comes back to the basics and the fundamentals of investing to say, have an emergency fund on the side, have cash on the side or assets that you can easily liquidate to make sure you can pay for things if you lost your job or anything like that. So you don't have to sell stocks, because imagine having to sell stocks when the market is down. When the market's up, you're flying high and you're wishing, wow, I wish I added to those. I wish I put more money in. How many of you wished you could go back to March or April of 2020 and dumped all of your money in? Loads of you, right? So now you're potentially getting the time where you could do the exact same thing. But of course, you still want to do that in a sensible manner and making sure you do that, looking after your nest egg for the long term. You do not want to be interrupting your compound interest, as Charlie Munger would say, and selling stocks because you have to. That's the absolute worst thing. Of course, you should sell and do whatever you want on your own terms. You may be selling a stock because you want to get a better one, for example. Don't just hang on to stuff just for the sake of it. Make sure you do what's right for you. But ultimately, just remember that having the basic stuff in place can make you sleep much better at night, regardless of whether your stocks are down 50%, 60%, 80%, or dare I say it, even more if you're really unlucky. But anyway, you'll get the point. Anyway, thank you so much for watching. I'll put the playlist now up for all of my other portfolio updates. Follow them through. I've got my free trade one, got Lightyear. I've got my Vanguard one as well. So enjoy all of those. And thanks again for tuning in. Drop me a like on the way out, subscribe for more. And as always, happy investing.